to the first policy of this financial year. At a time when the global economy is facing unprecedented challenges, from heightened geopolitical tensions, the conflict in West Asia, for which a temporary ceasefire was announced today, and the disruption in global supply chains. Before the outbreak of the West Asia conflict, India's macroeconomic fundamentals exuded confidence, with buoyant growth and low inflation. Conditions, however, turned adverse in March with the widening of the conflict zone and its intensification. The fundamentals of the Indian economy are on a stronger footing at the current juncture than it was in previous crisis episodes, as well as relative to many other economies, providing it with greater resilience to withstand shocks. Global growth faces increasing downside risks as the sharp rise in energy prices and shortages, some of which we saw a correction today in the prices of energy, and shortages of inputs for various industries have stoked inflation fears and pushed up the geopolitical risk premium in the oil markets. Heightened uncertainty precipitated by the ongoing conflict is weighing on the outlook. Safe haven flows have exerted depreciation pressure on currencies of major economies as the US dollar strengthened, while commodity prices such as of metal and gold have moderated. Financial markets have become more volatile. Equities registered a broad-based correction. Sovereign bond yields, already elevated due to long-run fiscal sustainability concerns, driven by inflation fears, have hardened across major economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on 6th, 7th, and briefly today in the morning of April to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged under the liquidity facility at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly state the rationale for these decisions of the MPC. The MPC noted that since the last policy meeting, geopolitical uncertainties have heightened significantly. Headline inflation remains contained and below the target. However, upside risks to the inflation outlook, driven by increased energy prices, pressures, and probable weather disturbances affecting food prices, have increased. Core inflation pressures remain muted, although supply chain dislocations and the risk of second-round effects render the future inflation trajectory uncertain. The MPC further noted that high-frequency indicators till February of this year suggest the continuation of strong momentum in economic activity. Growth impulses continue to be supported by robust private consumption and investment demand. However, the West Asia conflict is likely to impede this growth. Higher input costs associated with increase in energy prices and international freight and insurance costs, along with supply chain disruptions that could constrain availability of key inputs for downstream sectors, would impair growth. The government has taken several measures targeted at supporting exports and protecting supply chains. This should mitigate the adverse impact of the conflict. The MPC opined that the intensity and the duration of the conflict, as well as the resultant damage to the energy and other infrastructure, add risk to the inflation and growth outlooks. However, the fundamentals of the Indian economy are on a stronger footing, providing it with greater resilience to withstand shocks now than in the past. It also noted that the economy is confronted with a supply shock. It felt, therefore, prudent to wait and watch the changing circumstances and the evolving growth inflation outlook. Accordingly, the MPC voted to keep the policy repo rate unchanged, even as it remains vigilant, closely monitoring incoming information and assessing the balance of risks. The MPC also decided to continue with the neutral stance, retaining the flexibility to respond judiciously to incoming information. Before I provide an assessment of growth and inflation now, let me briefly elucidate on the channels of transmission through which the Indian economy may get impacted by the ongoing conflict. First and foremost, elevated crude oil prices could increase imported inflation and widen the current account deficit. Second, disruptions in energy markets, fertilizers, and other commodities may adversely impact industry, agriculture, and services, reducing domestic output. Third, heightened uncertainty, increased risk aversion, and safe haven demand could impact domestic liquidity conditions, economic activity, consumption, and investment. Fourth, weaker global growth prospects may dampen external demand and reduce remittance flows. Finally, adverse spillovers from global financial markets could tighten domestic financial conditions and raise the cost of borrowing, some of which we have already witnessed. Overall, the initial supply shock can potentially transform into a demand shock over the medium term if the restoration of supply chains is delayed. I now come to the assessment of growth. As per the new GDP series, real GDP growth for last year is estimated at 7.6%. This corroborates the underlying strong momentum in economic activity supported by robust consumption and investment. Amidst supportive policy measures, ongoing structural reforms, and favorable financial conditions. Going forward, elevated energy and other commodity prices, as also shocks to availability of inputs due to disruptions in the Strait of Hormuz, are likely to impact growth this year. The government has, however, been active in ensuring supply of inputs across critical sectors to minimize the impact of supply chain disruptions. On the other hand, sustained momentum in services sector, persisting impact of GST rationalization, which was carried out last year, and the healthy balance sheets of financial institutions and corporates should continue to support economic activity. The agricultural sector's prospects are supported by healthy reservoir levels. Business expectations remain optimistic, and leading indicators point towards continued resilience in manufacturing and services sectors. Moreover, the government's focus on scaling up domestic manufacturing in several strategic and frontier sectors augurs well for India's ensuing growth trajectory. On the demand side, private consumption this year is expected to be supported by discretionary spending. Rural demand remains robust. It should gain further traction on the back of favorable agricultural conditions and a healthy labor market. Urban consumption is likely to strengthen further, aided by the beneficial impact of GST rationalization and the buoyant services activity. While the government's thrust on infrastructure spending continues, the revival in private sector investment is expected to sustain on the back of high capacity utilization, strong credit growth, and benign financial conditions. On the external front, merchandise exports could be adversely impacted from disruptions to key shipping routes, the concomitant rise in freight and insurance costs, and lower global demand on account of the conflict. However, merchandise exports may benefit from the recent trade agreements, many of which were signed last year, and few of them are now in implementation, and others to become operational hopefully this year, while services exports are expected to remain resilient. Taking all these factors into consideration, real GDP growth for this year is projected at 6.9%, with Q1 at 6.8, Q2 at 6.7, Q3 at 7, and Q4 at 7.2%. Further escalation and wider spread of the conflict, as of now, of course, we have a ceasefire, heightened volatility in global financial markets and weather-related events, however, weigh on the domestic growth outlook. Risks to the baseline projections are tilted to the downside, with uncertainty remaining elevated due to the ongoing West Asia conflict. Coming to inflation, in January, February, headline inflation continued to remain below target. It was 2.7% and 3.2% respectively, with food group recording inflation. It was in deflation mode, as you are aware, in the previous 4 months up to December. Inflation in fuel terms was modest, core inflation at 3.7%, and the underlying price pressures benign, as evident from the much lower core inflation if you exclude precious metals. Turning to the inflation outlook, recent spikes in energy prices due to the conflict have emerged as a risk, although retail prices of petrol and diesel have remained unchanged so far. The pass-through of higher global energy prices has resulted in some price increases in a few other fuel items. Food price outlook remains comfortable in the near term, with a robust Rabi production that we had, adequate reservoir levels which would help agricultural activity, and comfortable buffer stocks of food grains. The likely emergence of El Nino conditions could pose a risk. Considering all these factors, CPI inflation this year is projected at 4.6%, with Q1 at 4, Q2 at 4.4, Q3 at 5.2, and then going down in Q4 to 4.7%. Core projection is projected at 4.4%. We are doing this for the first time, as has been the demand for some quarters. And going forward, we shall continue giving our projections for core inflation too. Excluding precious metals, core inflation is even lower, indicating that underlying inflation pressures are expected to remain contained. The risks are on the upside. I shall now speak about the external sector. Global trade is expected to witness a slowdown in growth during 2026 as compared to 2025. This is due to the lingering tariff-related uncertainties, despite the Supreme Court judgment, ongoing conflict, 0.2% during the first 2 months of this year on a year-on-year basis. This was a result of export traction in key markets. Merchandise imports, on the other hand, recorded a double-digit growth of more than 22%. This is largely driven by higher gold imports. As a result, there was a widening of the trade deficit. Expected robustness in services exports and inward remittance receipts during Q4 last year, however, should keep India's current account deficit moderate and within the sustainable level last year. Rising global uncertainties and elevated prices of key energy commodities pose some upside risks to India's current account deficit this year. The recent bilateral and regional trade agreements with major trading partners are expected to boost India's trade and investment opportunities, while at the same time, they will also widen and diversify India's trading partners and integrate India into global value chains. On the external financing front, gross FDI witnessed a strong growth, almost about 20%. Net FDI also showed improvement on a small base of last year. India remains an attractive destination for greenfield FDI projects. FPI to India, driven by outflows, primarily in the equity segment, recorded net outflows of $16.5 billion last year. And even this year, till we have data till April 6, there were outflows of more than $5 billion. Flows under ECB and non-resident deposits too moderated as compared to last year. And as on April 3, for which we have data, latest data till April 3, India's foreign exchange reserves stood at a healthy $697.1 billion. These are adequate in terms of the standard metrics of reserve adequacy, whether one sees it from the perspective of import cover, we have about 11 months, as has been the case for some time, or whether one looks at it from the perspective of external debt. Overall, therefore, India's external sector indicators remain favorable. Nonetheless, elevated global geopolitical, trade, investment uncertainties require a continuous vigil of the evolving developments. Despite stronger macroeconomic fundamentals, the Indian rupee in the last financial year depreciated more than the average in the previous years. In this regard, let me reiterate, I've said it many times, our exchange rate policy remains unchanged. Specifically, intervention in the foreign exchange market is aimed at smoothing excessive and disruptive volatility without targeting any specific level or band of price for the exchange rate. This is consistent with our long-standing policy of exchange rates being market determined. And we in the RBI stand committed to this policy and would judiciously continue to contain excessive or disruptive volatility to ensure that self-fulfilling expectations do not exacerbate currency movements beyond what is warranted by fundamentals. I shall now be speaking on the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.3 lakh crore rupees since the last MPC meeting. The Walker since then has traded in the lower half of the corridor, except towards end March, which is an yearly phenomenon. Short-term money market rates, especially those of CPs and CDs, commercial paper and certificates of deposit, they remained elevated. GSEC yields remained largely range-bound with a softening bias in February. But thereafter, on account of the ongoing conflict, they hardened, as did the global yields, along with the rise in the energy prices. Transmission in the credit market has remained satisfactory. To ensure sufficient liquidity in the banking system, the Reserve Bank proactively undertook durable and transient liquidity measures. Going ahead, we will continue to be proactive and preemptive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy. As for the financial parameters of the banks and the NBFCs, let me inform all of you that the parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. Similarly, the system-level parameters of NBFCs too are sound, with adequate capital and improved GNPA ratios. As per the latest available data, credit from all sources, not only bank but also non-bank and others, grew at 14.3% YOY. This is in comparison to the 11.7% growth that was witnessed a year ago. Bank credit growth too maintained its upward trajectory. You are aware it had gone down to about 9% in mid-2025. Moreover, it has remained broad-based. I shall now, as has been the practice, announce some measures related to some additional measures. They relate to ease of doing business, capital adequacy for banks, and market developments for one of the segments. I have three measures for promoting ease of doing business. First, to facilitate better utilization of bank board's time. This has been a request from the banks. We have done a comprehensive review of all our extant instructions, which are spread over various directions and regulations. And we propose to now revise and rationalize the matters which require attention of the board. Hopefully, this will result in the board being able to divert more time on policy matters, leaving operational matters to the management. Second, you would recall that we had recently in 2025 done a detailed exercise to consolidate over 9,000 regulatory instructions into 238 master directions. Now, a similar consolidated exercise has been completed for all our supervisory instructions, and we shall be issuing the consolidated instructions in this regard. Third, to facilitate ease of doing business by MSMEs, we propose to dispense with the requirement of due diligence while onboarding them on to various trades platforms. For capital adequacy of banks, there are two measures proposed. First, it is proposed to remove the condition regarding NPA provisioning for inclusion of quarterly profits in their CRAR computation. Second, in view of the developments in prudential framework over the years, it is proposed to dispense with the requirement which was laid down a few years ago to maintain an investment fluctuation reserve as an additional buffer to hedge against depreciation in the value of investments. For further development of the term money market, there is one measure, as I mentioned. We have decided to permit certain additional categories of non-bank entities in this market segment. You would be aware only banks and standalone primary dealers or SPDs are today eligible to participate in this market. We are also enhancing the borrowing limit of the standalone primary dealers in the term money market. To conclude, global economic conditions and sentiments have soured after the outbreak of the West Asia conflict. These have adversely impacted the growth inflation outlook. As reiterated before, we shall remain vigilant of the evolving situation and put in place policies that prioritize the best interest of the economy. Thank you, Namaskar, and Jai Hind.